Welcome to the Commercial Insurance Channel. My name is Rick Faber, co-founder of Underwriters Resource. This is part 3 of a 4-part series on how to insure garage risks. In this section, we're going to delve into the intricacies of garagekeepers coverage. Welcome back. Welcome back to Insuring Auto Service Garage Risks. This is part 3 of a 4-part series. Again, I'm Rick Faber, co-founder of Underwriters Resource. Before we move on to garagekeepers coverage, I thought we'd do a short recap of parts 1 and 2. First is ISO no longer offers garage coverage to non-dealers. The second thing is we now use a combination of the general liability and business auto coverage forms. And finally, the use of the general liability and auto increased the flexibility to cover all exposures. There's a lot of confusion about the differences between garagekeepers coverage and garage liability. Garage liability basically covers things like people tripping and falling on the premises or products completed operations resulting from faulty work. Whereas garagekeepers coverage actually covers damage to customers' vehicles which are in the care, custody, control of the garage business. Under the garage policy, it was included as an intrinsic coverage option, and it would be triggered by inserting limits on the deck page. However, under the new ISO approach toward repair shops, it's added to, as an endorsement, added to the business auto policy in inserting limits. Just like with physical damage coverage for vehicles, you do have similar covered peril options for garagekeepers coverage. One is for comprehensive, another is for specified perils, and a third is for collision and overturn. Pretty similar to physical damage, and I don't think we really need to go into too much talk about those. But one thing I do want to mention is that now there is just one single loss limit for garagekeepers coverage. In the past, ISO had actually had 2 limits, one on a per vehicle basis and one for an aggregate loss. Here's a copy of the declarations portion of the garagekeepers coverage CA 9937, which is now used in conjunction with the business auto policy. You'll see there up at the top is where a limit for comprehensive would be inserted. And you will also notice that right underneath it that there are actually 2 potential deductibles that could apply, one that is based upon each customer's auto and one maximum deductible for any single loss. So there's one per vehicle and subject to a total per loss. Now, if you go down low toward the bottom section where collision is, you would insert a limit for collision, and there is just a deductible per each customer's auto. I would like to add that you can have different limits for comprehensive and collision. You do not have to have the same limit. As a matter of fact, most garages opt to go with a lower collision limit than they do a comprehensive limit. And the reason for that is the reality is that with collision, you're really only talking about a maximum of 2 or 3 vehicles getting damaged at one time versus maybe a comprehensive loss where maybe you have numerous vehicles that are damaged in a fire or some sort of natural event. There are 3 garagekeepers coverage triggers available. The first is legal liability, which is the most common and probably, in my opinion, the most cost-effective. Legal liability requires that the insured be legally liable for a loss in order to trigger coverage. If they're not liable for the loss, there is no coverage under the garagekeepers. The second thing to know about it is that there is no surcharge on the rate for legal liability. And it is also, finally, it is the default trigger. If you have not selected any other triggers for the policy, it will default to legal liability. The second trigger option is direct primary coverage. Unlike legal liability, direct primary does not require the insured to be legally liable. And it is also a primary coverage, so this coverage steps in front of any coverage that the customer may have on their own vehicles. I kind of liken direct primary coverage to a goodwill coverage. It's something that you don't need to have, but if you want to buy it, it actually provides coverage for your customers and really doesn't cover the garage owner per se. It provides additional coverage for their customers. The other thing you want to know about it is because it is broader, there is a 35% surcharge over legal liability rates. So if your legal liability premiums are $1,000, the premium for direct primary will be $1,350. And finally, you actually have to select this coverage, this trigger, in order for it to be in effect. In the endorsement, there is a box that, as shown below, where you would have to put an X in there in order for primary insurance to be triggered. The third trigger option is direct excess coverage. Rates are surcharged 15% over legal liability rates. And similar to direct primary coverage, you select the coverage by putting an X in the box marked excess insurance that shows up on the endorsement. Direct coverage applies only to losses over other collectible insurance. Otherwise, coverage is strictly on a legal liability basis. Many agents have asked me, when is direct coverage needed? And I tell them that legal liability protects the insured. It completely protects the insured. If the insured is liable for the damage, the policy steps in and pays for them, subject to the deductibles, of course. Direct coverage is only needed when there is some sort of reason that they need to provide some goodwill coverage to their customers. You know, perhaps they're in an area where they're working with high valued vehicles and they need to do that because of who their clients are, and alluding to the fact that maybe they have some high profile clients and they don't want to have to worry about those customers not getting their cars fixed for some reason or another. In fact, it might impact their business because of a bad reputation for some reason or another. The next question I get asked a lot by agents is just how much limit is needed. You know, well, it depends. There's several considerations. You know, the first thing is the type of vehicles they work on. Are they working on just your ordinary Fords and Chevys and things of that nature, or are they working on BMWs, Lexuses, or Porsche, where you need more limit? The other thing is the type of lot that they're located at. If they're at a strip mall and it's basically the cars are stored outside in the public lot, there's a lot less liability passed on to the client. They could probably get away with less limit versus if they have a private lot. You know, if you have a private lot, you start to end up being responsible for more things going on in your lot. And the third thing that actually could increase the need for more limit is if there's certain types of security that they're providing. The fact that they are providing security means that they're more likely to be liable for some losses that they might not necessarily be liable for, because they are in fact providing security and they're giving that level of protection for their customers. And the third thing is maybe some catastrophic exposures. Perhaps we're providing some coverages in the north where you might have more exposure to storms, things like tornadoes and so forth, versus, you know, if you're in Arizona like I am, you really don't have that much in line of catastrophe exposures. There are several methods you could do to kind of come up or calculate a limit that's needed. One approach, and this is probably the safest approach, but it's also the most expensive approach, is determining a maximum value of vehicles. In this case, you're going to estimate the maximum number of vehicles that are going to be on their lot that they may be responsible for, and you're going to multiply that times the highest valued vehicle that they work on. For instance, if there's maybe a maximum of 10 vehicles and the highest value of the vehicle that they work on is a high-end BMW, maybe you're going to take 10 times, you know, 75,000, whatever the value of that BMW would be, to come up with the limit that they need. Another method that I've seen people apply is what I call the maximum value of vehicles inside approach. In this case, you're going to take the maximum number of vehicles that may be inside the building, which is in some ways the maximum number of vehicles that could be damaged in a fire, which is probably what you're talking about in a catastrophic loss that's going to damage more than one or two vehicles. And then you'll take that number, the maximum number of vehicles, you multiply that times the highest value of vehicle that they work on, and that equals the limit that they need. Now, using a limit that is based upon the highest maximum value does have a pitfall, and the pitfall is that you're going to pay more money for it because you're buying more limit. And in some ways, it's not always practical because basically the coverage is going to be triggered by an actual cash value of the vehicle, and the purchase price of those vehicles are usually a lot higher than the ACV. So it's not necessarily a practical amount. The other thing is that if you're basing it on the maximum number of vehicles, you might not usually have that number of vehicles either inside or in the lot. So maybe you want to take an approach and look at maybe what's the likely number of vehicles that are going to be in their lot. And again, looking at the maximum value of any single vehicle could create a situation where you're paying more premium because not all the vehicles are valued that high. Maybe rather than working off the maximum value of a vehicle, work off of the average type of vehicle and the value that would be applied to an average type of vehicle they work on. And then again, the type of trigger that they selected might actually encourage them to carry a higher limit. For instance, if they're carrying direct primary coverage because there is no need for legal liability, they might want to buy a higher limit because that policy would be responding to things that are acts of God, like tornadoes or hailstorms or hurricanes or floods or things of that nature. So, if they're selecting direct primary, they may want to actually start thinking about selecting a higher limit rather than a practical limit. And the other thing I get asked a lot is about coinsurance. There is no coinsurance requirement on garage keepers. I briefly mentioned earlier when I showed you the declarations page for garage keepers coverage, but here's how deductibles are applied. For comprehensive and specified perils, there are two deductibles. There is a per vehicle deductible, and then there's a per event deductible. Usually the per event deductible is 5 times the per vehicle deductible. So the per vehicle deductible is the most the insured is going to have to cough up for loss to any single vehicle, but that is going to be subject to a maximum event deductible that will limit the amount that the insured will have to pay if multiple cars are damaged. And collision carries purely a per vehicle deductible. It does not have a per event deductible. So we've come to the end of the section on garage keepers coverage, but here's some key points that I want you to remember. First of all, legal liability completely protects the insured for damage to vehicles in their care, custody, control. If they are liable for that damage, they are covered. They are protected. Direct primary can really be considered as a goodwill coverage. And there are many ways to determine the amount of limit needed. And typically, legal liability focuses on actual cash value rather than replacement cost. In part 4, we'll dive into underwriting auto garage risks, what you need to know, and how to evaluate it. If you like this video, please be sure to like it and subscribe to future videos. If you have any questions about the subject matter in this video, please leave them in the comments section below or email us at richard.uwresource@cox.net. Remember to like this video. The subject matter in this video is approved for CE credits in several states and available for in-house classes. If you are interested in scheduling an in-house CE session, contact us via email at richard.uwresource@cox.net.